Good day, everyone, and welcome to this Alternus Q3 webcast hosted by Arctic Securities. My name is Daniel Stenslet. I'm the equity analyst at Arctic covering Alternus. I will moderate the session. With me today, I have CEO Vincent Brown and CFO Joseph Dewey, who soon will take you through the highlights from third quarter. After the presentation is concluded, we will move over to Q&A, and I urge you all to use the chat function to send me questions, which I will bring forward towards the end. With that, I think we're ready to begin, and I leave the word to Vincent and Joseph.
Well, thank you, Daniel. Good morning, afternoon, or good evening, depending on where you might be in the world. I'm pleased to actually be joining today from the large-scale solar CE conference in Poland, where Alternus are one of the sponsors, and we'll be speaking on a panel tomorrow about the markets here in the CE. But with that said, let's look at Alternus's third quarter, which I think has been one of really the summary is execution against the plans we had set out, and we're very pleased to complete all of the planned acquisitions in the initial bond portfolio. But more importantly, we have reported in this quarter all-time high revenues and profits for the company for both Q3 and year-to-date September 21. Again, very much in line with what we had anticipated, but revenue is up 370% year-on-year, 69% corporate EBITDA, which is about 79%, which again in line with gross margins, and a positive net income both in the quarter and the year-to-date. So exceptional revenue or financial performance for the company in the quarter just gone. We also, at the end of September, have owned our largest ever asset portfolio, which now stands at 472 megawatts. Obviously, of that, 130 megawatts are operating, which is up 4 times than where we were this time last year. We have 18 megawatts in construction as per last quarter, and the remainder of that is in various stages of development, which we'll talk through here in the presentation. I think really significant, but happened just after the end of the quarter. We did recently complete a successful 20 million bond tap issue against our 3-year bond, but more importantly, it's showing that the cost of debt is reducing for the business as we scale up. This is seen also in our other debt conversations that we have for construction financing needed to grow out the portfolio. Again, we can touch on that a bit later. But the bonds themselves now netted a 5.5% net yield, with strong investor demand for the 20 million bond. In fact, was oversold a bit. So we're very, very pleased with that. I think it underpins our business model, underpins the demand for assets such as ours in mid to central Europe. And so we feel it's a very, very strong quarter overall for the business and underpins both the model and the future. A little bit more revenue, or a little bit more detail, should I say. Revenues for Q3, 7.1 or 3.5 times last year. EBITDA 4.9 million, which was up from a negative 200,000 last year. Again, really proving the economies of scale that come with a business model such as ours, as we add cash flowing assets with a very low fixed cost base. Net income was actually positive for the quarter also. That may not necessarily trend into Q4. Obviously, given the bell-like nature of revenues, Q4 will always be slightly less than Q3 was, but still very positive to have a positive outcome for the year so far. Again, similarly, 9 months, we've hit 13.1 million in revenues, or 3.7 times last year, and our EBITDA stands at 7.1. We, significantly up again on the same 9-month period last year, and indeed our net income standing at 10.6 for the period, which again I think is very positive. All positive indicators for the company as we continue to grow and deliver on our stated goals. So let's look at largest ever asset base. As mentioned, we have continued to grow out the overall asset group in the company. We did move successfully 50 megawatts of contracted assets, now moved into owned during Q3. Now these are development assets in Italy specifically, but again, very significant to see it moving to the left. We expect to see some of that continue in Q4. Some assets are moving through the due diligence process. We will see in the next slide that some assets have not met our due diligence criteria, so some of them have dropped out. But again, we have filled in with the pipeline moving consistently from right to left, and we're targeting to have an additional 100 megawatts by the end of year 2021 in the owned column also. And again, we'll be issuing details on that as they arise in the quarter. And again, significantly, the pipeline grew by 20%. So again, our generation of new assets to acquire new projects is proving robust and continuing to add to the ability for the company to really pick projects that make the most sense to pick and that are the most financially beneficial to the business, which I think is significant at this point in the business cycle. Now, last quarter, we introduced this slightly more detailed chart. We do get a lot of questions from both analysts and the investment community as to where are the projects in their phasing and in their status. So we've added a little bit this quarter to, again, try and get more transparency around how the dynamics of the business ultimately work here. So again, good news, we have 130 of operating assets here on the top left. We've increased now to 342. 18 of that is still in construction, but 14 megawatts of that is the Rotterdam Airport, which is on track for COD in early Q1 2022. So we're very pleased about that. As I mentioned, we have moved 50 megawatts of contracted assets into owned during the quarter also. And you can see there on the left, the developments, we're expecting that 1/3 approximately of the current development pipeline will be COD in 2023, with the remainder in various quarters over 2024 as we see it now. Again, the bottom line, the development group is the group we ultimately expect to be able to finance pretty much with debt over the time frame that these are coming online. So we don't see any significant equity need to continue to develop and bring these assets into operation over 23 and 24. But obviously, if we left everything till 23 and 24, we wouldn't have a huge amount of growth in 22. So continuing in with our stated targets of achieving the 1.5 gigawatts by end of 2023, we have reshifted our focus on our new project acquisition since the last quarter into more construction and ready to build projects. As you've seen, these numbers would be higher than they were in the prior quarter. I think they're more like double now. And we can see here that of the 665 megawatts, approximately 120 megawatts and 200 megawatts will be constructed and completed, we expect, in 2022. When you add that then to the 113 contracted operating parks, and 15 of that, for example, will be completed at the end of 21 from the recent bond proceeds. So they'll move over by the end of this calendar year. And then we have about 98 remaining, which is targeted for acquisition in the first quarter, currently in due diligence. Again, all of our contracted projects means we have exclusivity, means we have agreed the cost price to the group, and it's up to Alternus whether it proceeds or not proceeds with projects depending on how those due diligence activities are outcome. So you'll see, for example, the development bar is a little less than it was in Q3. And some of that, okay, is caused because it's moved over into owned, but we've also rejected, based on some due diligence, some projects that we won't be proceeding with at this time. They may come in later again. But again, as we sit here at the contracted, this is the numbers and when we expect these to be operational and contributing EBITDA to the group, which over time will, on execution of this phase, the way this looks, then effectively we will hit our 673 and just over 1.5 gigawatt stated target. So we're still, as we sit today, on track to achieve these pretty aggressive growth targets. We are looking to see 174 in 2021. Some of that will be under construction at that point, but it'll be very close. So we do see that number as pretty solid, as I said, in terms of operating or in construction or near-term operation. And we're now, based on this previous slide, as you've seen, well in hand on adding the 499 that we would like to add in 2022. Again, at prices and returns similar to what we've seen in the past and what we're expecting in our business planning. So again, if we look at that in the longer term, 2025 operational target is 3.5 gigawatts. In fact, it hasn't increased. That's it was our original plan from January. But that would indicate 110 million IRRs at the end of 2023 at 1.5 gigawatts and over 250 million IRR should we achieve the 2025 target, all of which we believe and are not changing our outlook on achieving these numbers as we grow. I think one point to add, we are in advanced debt negotiations with various institutions around how to, closing on the funding, particularly for this 120 megawatts here, to set to close and start construction in Q1. We are in very advanced discussions on very attractive debt terms to fund those groups. We expect those to close in line with the contracts and in time to start construction. So we're very confident on that 120, and of the 200 similar discussions, they're a little later in the process, and based on our contracts, we don't have to purchase those projects until they reach that phase, but a lot of those are in Q2 and Q3 of 2022. So again, very, very visible pipeline, very visible contracted future, and good discussions on how to fund these acquisitions with the need, very little, if any, need for equity. We would hope and target. Again, sustainability is still at the heart of the business. I know the beauty of working in renewables today is that they're very economically attractive, but they're also, and we shouldn't lose sight of the fact that we are adding to the environmental benefits. And so we've seen that significantly grow over the last quarter as more assets have been added to the portfolio, and we're very pleased to be continuing to contribute positively to the environment in actual terms, as opposed to also just having a very strong economic model. So that's where we're a quick summary of the business since the last time we spoke last quarter. Overall, summarized in terms of execution against plan, very strong financial performance, very well positioned for future growth, with a very visible track record and a very visible pipeline to build against. So I'd like Joe to take you through the actual details of some of the financials as reported for Q3, and we'll summarize at the end.
Thanks, Vincent. So if you start out with, again, our overall performance is very strong. Obviously, the driver of our revenue is kilowatt hour production, which drives the entire business. So as you can see, we're up 2.7 times in this quarter from last quarter as far as the output of our physical solar parks. And again, majority of this increase obviously was for the acquisitions we did as part of the bond and equity raise earlier in the year, with assets in Romania that we added and some additional assets in Italy as well. And just the Polish project that we closed at the end of August was excluded from the Q3 as far as the production piece of it, but going forward. If you look at the revenues and EBITDA, again, as Vincent mentioned, very strong for the quarter, and obviously on the 9 months year to date as well. Margins right around that 80% mark for on a gross profit basis. And then obviously, in the increases in the revenue and EBITDA for both the quarter and the 9 months, specifically around the acquisitions that we did and closed out from the bond proceeds over the course of this year. From so again, just kind of a gap from as far as our annual recurring revenue. Again, you look at it, we started out at the end of the year around 4 million euros of annual recurring based on the projects we had. Through the second quarter, we had closed on the majority of the assets, which was around 16.6. And then with the final Poland asset that we closed at the end of August, additional 3.3 of annual recurring revenue. And if you look at our total asset base, there's still an average, weighted average of about 8.7 years of contracted remaining revenue. So that 19.9 million is, predictable over the next 8-9 years on average. And as Vincent mentioned, we're looking at new assets going into construction and things like that and being operational sooner. For example, if you look at our Poland asset that we closed at the end of August, that asset is going to have a 30+ year life to it. So that 3.3 million of recurring revenue for that asset, you'll see that obviously longer than the 8.7. It'll be about 25 to 30 years in nature that asset will produce. And then again, if you look at it just from where we were to where we are, again, as we mentioned, majority of that is coming from the acquisition and really the closing of the assets. Again, we closed about 15 megawatts in Romania at the end of March. We closed another 20 megawatts in the end of April in Romania, and then the larger 65 megawatt project at the end of August. So again, when we get into 2022, we'll be looking at that 19.9 million revenue as our recurring run rate as we move forward. Again, with all this, I think it's still a very strong balance sheet. If you look at it, we kind of broke it up a little bit between what we consider Solace Bondco, which is all the assets that were part of the bond process, and then at the corporate level as well. But as a group, we have about 182 million of total assets, and in there around a little over 40 million of equity at the end of the second or at the end of the third quarter. One thing to remember too, and I know we mentioned this on previous calls, but when we did the Poland acquisition, again, obviously there's a little delay in finishing the asset, but we received the benefit of the revenue basically the entire year. So that doesn't show up on the revenue line item per se, except for the period that we owned it. But we did have about a little over 1.5 million euro increase in equity for that particular park during the 9-month period and so forth. So again, that's kind of where that benefit is of that cash flow that we receive from that period shows up into the equity section as opposed to revenue. So on a cash flow basis, again, cash flow from operations, we use about 2.2 million. Now, again, this had about a 9.3 million of that was cash paid for interest. One of the things to note is, some of this is a timing perspective. So when we issued the bond early January, we were paying interest on it. At the same time, we hadn't refinanced all of our current owned assets as we were waiting for the process to happen and the securitization with the bond to move forward. So we ended up having about an additional 2.1 million of interest paid on our existing assets, which again would not happen as we go into 2022. And then the other difference from the cash flow from operations, again, just the timing of the acquisitions when they came online and how they ultimately generated to the cash flow of the company. As far as the investing side of things, obviously the money we got from the bond went to either new acquisitions or refinancing of the old pieces. So that was about 96.2 million. And then the net financing was around 116, which was predominantly the bond as well as the equity raises we did. And that's net of repaying off existing debt that I mentioned, as well as various fees and expenses. So our cash flow at the end of, or our cash at the end of the period was a little less than 20 million on the assets. And then just to kind of, I think one of the things that's really, Vincent talked about pipeline and contracted projects and things like that. I think that's really key as well. At the end of that is it also shows a very diversified portfolio when those assets go into play. So when you look at revenue and impacts on revenue, if something would happen at a particular asset, or a particular country, then that really has a very minimal impact on our overall business. As you can see, of the 472 that we have owned, we have quite a few in the Netherlands, but we also have assets in Poland, Italy, Romania as well. So you do have a lot of diversification, and most of our assets, again, either one specific asset is no more than 30% of the total revenue of the company as it is today. So again, it's a very diversified portfolio, which really de-risks our revenue going forward. And then again, as you look at as we grow out the assets, again, I think it's important to point out that these are the contracted assets. So these are where we do have agreed upon terms that we're going with the seller. We're going through the due diligence process. And that due diligence process is very extensive. As we mentioned before, we use top tier legal, technical, and financial groups to help us with that acquisition. So we can really identify, quality projects going forward and minimize the risk. Again, as we talk about diversified portfolio, you can see from the previous chart, we had quite a bit in Netherlands and other places. You can see how we are looking to expand in other countries, for example, Spain and Greece, which weren't on the previous slide. as well as increases in Ireland and Italy and so forth. So you can kind of see as we grow the company out how key that diversification is going forward, obviously to de-risk the portfolio and the revenue at the company level.
All right, so thank you for that, Joe. We've skipped on to the appendixes. We're not planning to go through them. They'd be available for download after with some interesting detail for those who would like to have a little bit more behind what we've spoken about. In summary, I'd like to just bring the view of the market. We do get a lot of questions around, well, panel prices are exploding. How are you coping with that? And at the same time, are there any benefits, and shouldn't there be benefits to the company from the current energy and foreseen higher energy rates, certainly in the European markets we operate? And the answer to both of those questions is yes and yes. However, from the cost of production producing and construction of a park, we have seen and have built in some of those extra panel pricing and component pricing, but we are constantly working with the larger tier one panel manufacturers. We're currently in discussions with a particular strategic partner on that front, and they're forecasting, and I think we're seeing that in the media, that the prices for these commodities will decrease up until the second part of next year, which is when most of our panels will be required. So even though we may be putting plants into production in Q1, at the time you need the actual panels, there's always a little bit behind a 3-month window there. So we have adjusted for that, and we have adjusted for them being higher. However, on the counter side of that, the assets themselves are worth more over a discounted cash flow basis, which is how all of renewable assets, and certainly our solar parks, are valued. And so the higher energy rates will in turn lead to a higher capital value. And we see a benefit for that over time, as we've locked in a lot of the acquisition prices now for the projects we have in our contracted. So if those values continue to increase, we would see an asset value benefit, which will benefit directly equity, because it allows us to raise debt without actually raising new cash equity. And I think that's an important nuance, and certainly a question we get a lot. And lastly, we're actually getting some near-term benefits. You can appreciate that even though we've 90% of the projects we have are on secured long-term fixed price contracts, that other 10%, and particularly, for example, in Poland, benefits greatly from the spot market increases. And any spikes right now are having a positive cash impact on the business. We haven't changed our outlook and guidance until we can see where they ultimately turn out to be. But we are expecting that we will get some additional EBITDA positivity over the course of 2022 from the existing assets that are operating today. And indeed, we should be balanced against the increased construction cost with the increased valuation over time, should the market trends continue as they are. Of course, they're market trends. We have to adjust as they change. But again, given that's a question we get a lot, I wanted to address that. But overall, I think that the quarter has been excellent. I think it's really summarized, as I said at the beginning, by execution against our plan, delivering against the promise, and showing both the investment market, but also, more importantly for me, the actual renewables market that Alternus is a significant early stage but rapidly growing and serious partner to work with. We're seeing that in the amount of projects that we're getting presented, as you can see back in the pipeline. So the heartbeat and engine room of the business remain very strong, and we're particularly excited about what will 2022 and beyond at this point. So with that, Daniel, I'll hand it back to you. Hopefully that's been of information and summary to the audience, and we would open the floor if there are any questions.
Great. So let's then start with the questions. So first one, when are the additional 15 megawatts which you raised capital for through the 20 million euro bond tap expect to be acquired, and when will these transactions be closed?
They're all targeted for before the end of this year. So we're currently going through the closing process with the various sellers and law firms and so on, but we're without any unexpected events, the 15 megawatts will be added to the portfolio and contributing immediately prior to the end of 2021.
Second question. What explains the large SG&A fluctuations quarter on quarter?
Oh, Joe, I'm going to bounce that one to you.
Yeah, so the SG&A differentials, if you look at the previous quarter and so forth, I guess the previous year was really related to some additional growth at the company level. As you saw the different pipelines and contracted revenues or contracted backlog of projects that we're looking at, we've put some additional resources in to help grow that pipeline and to help solidify the execution, as Vincent mentioned, going into 2022. But it was important for us to get those resources and people on board sooner rather than later, so that everybody's up to speed, and so we can continue the execution in 2022.
And I would also add there are a number of one-off expenses that have to be recorded in SG&A under IFRS, such as the listing costs, and they are not, unfortunately, they have to go through the P&L. So there's a lot of one-off. I think it's about $500,000 there. That would be a one-off event.
There were two major one-off events. One was related to some prior stock compensation that was, which had a non-cash impact, but again, under the accounting rules were taken in 2021. That was a little over $300,000. And as Vincent mentioned, some of the Euronext listing and other admissions processes that we've been going through was a little over 250,000 euros for those costs that are, again, one-time charges that we don't expect to have in the future.
I see. Thank you. Vincent, you mentioned the low equity need. Perhaps you could give us a rule of thumb for calculating the equity need for needed to bring, for instance, a given early stage development project to production.
No, and thanks. Yeah, great question. If you look at the dynamics of the projects, as we get earlier into the value chain, then we're taking a lot of the margin that a developer, and these are the people who create the project through planning and get all of its permits and connections and so on in place pre us joining at construction. We're now more involved in that process with co-development partners across the various countries that we're operating in, and that, as a result of that, then we get a lower cost for that element, and that feeds back directly into the valuation of the project at DCF. So all of the projects, when debt sizing and when a debt provider is looking at these projects, they're looking at the cash flows and the future cash flows. They discount that back at either their cost of capital rate and or a potential insurance company cost of capital. So there are various DCF factors that are used to value these projects. But the debt providers will look at it purely from a cash flow, and based on the cash flow, then we find, and certainly our maths currently shows, that when we bring a project through development and successfully into COD, then that the debt available at that point is not too far away from the actual cost that it costs to develop and construct a project at that point. Don't want to get too much more into detail on that, given we may be giving away some competitive advantage, but that's the reasoning behind that statement. But also because of the high predictability and the way we go to market using a bond structure over, for example, a traditional project finance structure, certainly in the first part of the asset life for us in the company, then that cash flow that would otherwise be amortizing debt too fast. For example, most bank debt will depreciate assets at 15 years, but they're 30-year assets. So we tend to take the first 5 years of that in a non-amortizing mode through either a bond or indeed a non-amortizing debt vehicle. And then we start to amortize the projects over the remaining 15 years. And that first 5-year period generates a lot of cash flow that is retained then in the company for future asset purchases. And that's what's happening right now with these after 15 megawatts that's being acquired in this quarter with the bond tap. So we're able to use the cash in Bondco that has been generated as equity from the operations of these projects into new project acquisitions. And so that's a non-equity dilutive, for want of a better term, process we can use to grow the business without having to increase new equity and new shares issued. And that's a key focus for the management team here as we grow the business out. Now, we're not saying we will never be back for equity or, you know, at what point in time, but based on the metrics we're seeing, we're trying to maximize the amount of debt and existing cash flows that we can use to grow the business without needing to raise new equity each time. And that's really a core management focus, as I said, as we buy new assets. So hopefully that answers the question, Daniel. So there was kind of two things there. You know, development assets themselves have a locked-in value, but also the way we approach the debt structuring for these projects, you know, delivers a significant equity value that would otherwise have to be raised in the market.
Excellent. And let's continue on that topic. So we have a very material backlog, and as you mentioned, the equity need is not huge, but the amount of debt is obviously significant to acquire these assets and bring them forward. So what sources of debt are you looking at? Do you look at debt facilities on asset by asset level, or do you look at more flexible multi-asset instruments?
Oh, excellent question, and I'm actually glad you gave us a chance to talk about that. We're currently in advanced discussions with a number of banking partners, mid-tier and large. There is a massive appetite amongst this group to fund projects such as the ones we're bringing through here. The rates are actually very, you know, we expect to be paying somewhere between 3.5% to 5% necessarily on construction finance based on the current discussions. But it is at the portfolio level, which again is something that we can benefit from and is attractive to debt providers, because whereas there's a group of projects underneath, it gives them diversification of the risk while various projects are in construction. And it's also, again, a benefit of our high growth. So it does vary, and in certain projects that are larger, we may need to bring in one bank for that. But we do have a sufficient and over demand in terms of debt for the projects, and we're just trying to maximize that in terms of how you structure it amongst the various groups that are interested. So, you know, it's one of the reasons I think why we're bringing these 120 megawatts now in Q1. We're expecting to close them and put them immediately into construction in the first quarter, and that debt has already been ring-fenced and committed to the company, for example. And we know that that covers a huge amount of the cost of those acquisitions and bringing the projects forward. So, you know, we're certainly happy to maybe, I don't want to hold up everyone on the call here, Daniel, but hopefully that helps understanding there. We're happy to have further discussions around debt. I mean, it's a key question we get all the time. You know, it is significant to see our cost of debt reducing. That's a fact now. We do expect that to continue, both if we do bond issuance of operating assets over the course of next year or future taps. You know, that's at market. The tap was funded fully at the market at the time, but also in the construction financing that we're seeing, like revolving credit facilities that will allow us to plan out into 22, 23. And again, because of the size of the backlog, it's actually a benefit because the banking partners can see a dedicated delivery of debt, which is what they need for scale over that 2-year period. And that's opening up markets that are opening up debt facilities and debt opportunities that we wouldn't have had this time last year.
Thank you. And next question. Your exclusive set of options to acquire assets for a defined amount. What is typically the duration of these options? One would expect that they're not lasting forever and perhaps milestones that need to be met.
Yeah, again, super clarification. On average, it can range anything from 3 to 6 months. The average is 3 months because it takes that length of time to get through due diligence. If we're happy with due diligence and both parties will then move into a 3-month kind of SPA, you know, purchase documentation position. So we always have 3 months, but in reality, it's 3 to 6 months between the time we start and the time we would close. And as you've seen, various projects don't always make it through to the second part of that phase. So it's a highly fluid scenario. It is the heartbeat of the business, and we don't just pick any project that comes along. We're in a very somewhat luxurious position, even though it's generally a seller's market. We seem to be able to, take projects that make the most sense to us, and have the luxury of not taking every project that's presented. But to answer the question, 3 to 6 months is the average, and we tend to be within those windows most of the time.
Thank you. And to continue a bit on the market discussion, you mentioned, Vincent, that of course we're seeing some increase in solar module prices and increasing shipping costs, etc., which could impact the capex side of your business. But if you look at the development portfolio on a standalone basis, which should be the subset of the portfolio being most exposed to this increase in capex, how is this cost factor being balanced by higher PPA prices? Because there's also, as you're aware, and also as it's reflected in the numbers, it's been a very rapid increase in electricity prices on the European continent. So how is really the discussions with regards to off-takers and PPA prices? Could you comment on the extent of the upside that you may benefit from in terms of higher PPA prices?
Yeah, let me again maybe take that in two chunks. If we look at the construction cost and the component costs, as mentioned earlier, in terms of panel and mountings and inverters and whatever, the panel prices have seen a spike. Our input from the industry on that side is that spike will alleviate second half of next year. That's why we're seeing a lot of projects push out, not from our projects, but in general in the market. So we have taken a strategic view of, and we don't want to say too much yet, but we're looking at having a secure panel supply. We are at very advanced discussions on that to standardize our panels across all of our parks. And that would give us a certainty of supply, and it would give us not so much a discount, but it would certainly give us an ability to have a very strong negotiation position for our panels. We will, update the markets as that progresses, but that's kind of the core strategy we have over the next 2 years. We have a lot to build. It's about a gigawatt plus more, in fact, 1.23 gigawatts from where we are today. So we're planning for that now. That's also where Joe was alluding to in terms of SG&A costs creeping up a bit. We're investing now to be able to deliver all of these projects over that period of time. And we've got a good degree of planning in the management for that roadmap and that level of activity. And one of them is securing panel supply. So whereas there's a little bit, but also as part of that panel supply, we're basically saying, hey, we want you to ship X amount of panels every single month to us, irrespective of what project it may be for. We will then manage the logistics portion of that internally and allocate it to the numerous projects we will have underway and have currently underway. And so that also allows us to mitigate some of the shipping costs, because basically everyone can plan a long time out. And we're going to see some benefits from that we expect. The numbers are too early to understand in terms of where that is, but that approach is seen as somewhat unique in the market and will give us a lot of flexibility in terms of how we concentrate on the costs on that side. I think on the energy side, look, we're clearly in a spike right now. There's numerous factors for that. I don't need to second guess the markets on that, but it's not seen as long term. But I think what is understood is that the energy rates will reduce, obviously, from the spike, but they will settle down at a rate higher than originally we would have anticipated last year or through the course of 2021. So we are getting that from our forward price curve advisors. They are planning that all electricity rates across Europe will be higher. It seems to be about 15 to 20% higher, but that's really going to vary across country to country. But if we were to apply that to our existing projects, for example, then we get a benefit of on the 10 to 15% of the projects that aren't fixed. But more importantly, we will then get the PPAs are reflecting, and we're seeing that actively in the market. We're constantly discussing PPAs with PPA off-takers, both corporate and utility, and we're seeing higher rates being employed in those contracts. So yes, we will for sure benefit from them, but it's too early really to say by how much, and we would be a little bit hesitant to quantify it. But I think in principle, we would expect to have if it does remain at 15 to 20%, for example, well, that would be a significant equity increase that we would have already locked in, for example, right now. But there's a bit of a road to go, to be fair, in terms of getting all these projects through a process and those rates ultimately lasting in that way. But all indications are that there's definitely an upside, and we will be positioned to benefit from that upside.
Just a quick follow-up. Will it be possible to indicate some share of that? If you look at the forward curves and you say it's up perhaps 20% or somewhat more, depending on the country and the region, but how much of that increase in forward prices that could be transferred to PPA prices? Is it like 50% of the increase? Would that be reasonable, or should it be somewhat higher or lower, you think?
No, look, I think on average, a PPA is always below the market. So, PPAs serve a purpose for debt more so than they do for equity. If everything could be done at merchant, everyone would actually make more money. But the PPAs are, in my experience, about 5 to 10% below where the actual rate would be in the merchant market. So if you multiply that in, then the 20% would flow upwards across the board. So if they're already, for example, Daniel, 10% below the current market, then of course they would be still 10% above a higher market. So ultimately, if it is 15 to 20%, it should flow directly into the PPA. So I don't think there's a share, shall we say, the upside that wouldn't be close on 100%, because it's literally just they're stepping up from where both levels are today.
That's certainly attractive. Thank you. And a question on diversification and technology. Have you started to look more into, for instance, combining storage into your solar parks, or even diversify into wind? Is that something that you're planning to or look at?
Well, look, I think we're always looking at new things to do, but we have a big chunk of work ahead of us in the next couple of years. I think in all our development projects, we see that as being essential. The corporate goal is to have 24/7 supply in 5 years' time, and that's going to be a myriad of different technologies that we'll have to understand. We do have a wind expertise in the company we didn't have before, I will say that. It would always be a nice counterbalance to solar. However, it's a whole other industry to digest. We are kind of growing aggressively, but at the same time cautiously. So we always have those hybrid solutions foremost in our mind. We are looking at some other, maybe not so much wind and other kind of hybrid solutions that are also will be attractive in the medium term. But we have to, I suppose, stick to the knitting is the term, and manage the resources as best we can with what we have. And I think that's an important focus we need to keep as we progress. I think when we're halfway through next year and we already have 400 megawatts in construction, and that's getting us to our 2022 target, I think the industry will be very receptive to all those new things we would bring along. We don't need them in the next 12 months is our view, but we are planning, for a 5-year horizon. And so all of our new development projects, for example, would for sure include other kind of hybrid solutions in the design, because that's the time to do it, and we have the most impact there. So I wouldn't think it's something will be in the next 6 months, but certainly over time we will keep you advised as to what we see unfolding there.
Very good. We've then gone through the list of questions. If you have further questions, I recommend using Alternus website, where you can post questions directly. Or if you want to discuss the investment case with me, I'm available for discussions. So that's it for now. Thanks to everyone for joining the call today, and I wish you all a good day. Thank you.
Thank you.